Good afternoon, everyone. This is Chuck Self, Chief Investment Officer for iSectors. I'd like to thank you for joining us today to review the iSectors third quarter 2015 performance updates. I will be providing a brief third quarter performance overview of all the iSector models and conclude with our near-term economic perspective on the markets. This call should last 15 minutes with questions and answers to follow. Please feel free to ask questions anytime during or after the presentation by clicking on the chart box in the lower right-hand corner of your screen. This presentation will be recorded and a copy will be available on our website tomorrow at www.isectors.com. Just click on the iSectors blog icon and it will take you to a link to access the recording. We will also be sending a link to access a recorded copy of this presentation to all webinar attendees immediately after this call. The Post-MPT allocations underperformed their benchmarks in the quarter. Post-MPT lagged due to healthcare holdings no longer in the portfolio and financial stocks. Both strategies benefited from Treasury bond allocations. As the chart on slide 3 indicates, Post-MPT growth continues to experience a shift in its allocations. The strategy is currently incorporating its lowest amount of leverage since early 2013, after tracking close to its 33% maximum for over a year. The model has significantly de-emphasized stocks. You will also note that the allocation continues to shift into bonds and has added small positions in real estate and gold stocks. In fact, the allocation's investment in U.S. Treasury bonds stand at its highest level since early 2012. Since the strategy's benchmark is the Standard & Poor's 500, the model is indicating that Treasury bonds are currently the most attractive asset class. Within equity holdings, both strategies continue to be overweighted in financials, and Post-MPT growth still has a healthy technology weighting. iSectors Post-MPT growth continues to outpace other global allocation strategies. We are pleased that the allocation is ranked third among 33 global allocation ETF strategies for 10-year performance and first out of 79 global allocation strategies for 5-year performance in the Morningstar ETF Managed Portfolio database. We expect Post-MPT growth to continue its reputation as one of the premier allocation strategies utilized by investment advisors. As you will see for a number of strategies, energy holdings continue to negatively impact endowment and liquid alternative allocations during the quarter. Both endowment and liquid alternatives could not keep up with its benchmarks. The supply-demand balance in the energy markets continued to be elusive. Also, the stock market slide impacted new and small equities tremendously. Fortunately, as you can see from this chart on slide 4, real estate, as indicated by the red line, held its own during the quarter. The black line shows the performance of an energy production ETF. Both allocations are broadly diversified and should recover when the commodity markets stabilize. In the meantime, it should be noted that liquid alternatives have outperformed hedge funds almost 250 basis points on an annualized basis since its inception in April 2009. Given the advantages of the allocation compared to hedge funds, including daily liquidity, complete transparency, and availability to all clients, not just accredited ones, liquid alternatives should be considered for diversification as equity returns ease. Unlike last quarter, domestic equities outperformed global equities. While both allocations benefited from an emphasis in dividend stocks, which are now outperforming growth stocks, both international developed and emerging markets underperformed the S&P 500. The global fixed income allocation was also negatively impacted by emerging market weightings in a quarter, while U.S. dollar bonds benefited from strong currency trends and falling U.S. interest rates. The iSectors domestic equity allocation has earned very attractive returns over the past 5 years compared to most ETF strategies. In fact, the domestic equity allocation is number 15 out of all 457 ETF strategies in the Morningstar database for 5-year performance. Metal market weakness and volatility continues to strongly affect our inflation protection and precious metals allocations. Precious metals continued its declines on the back of falling platinum and palladium prices. Thus, as you see in the chart on slide 6, for the ETF's Physical Platinum Fund, which as its name implies holds platinum bullion, the fund fell 10% in July, made a 50% recovery of the July loss in August, and fell another 10% in September. Metals, along with energy, negatively impacted the inflation protection allocation. Inflation protection's drop was tempered by its real estate exposure, as we previously saw. Given modest expectation for equities going forward and low interest rates, now is the time to revisit diversification in your clients' portfolios. Slide 7 presents the correlation matrix between traditional and alternative asset classes over the past 15 years as calculated by BlackRock. If you are interested in the details, you will be able to analyze the data after we post the presentation on our website. I have circled the correlation between commodities and large cap equities and the same between commodities and treasuries. Commodities and Treasury inflation protection securities, or TIPS, which are not listed on this chart, are the only two income-oriented asset classes with low or negative correlations to both stocks and bonds. The current yield of the iSectors inflation protection and liquid alternatives allocations are almost 2% each due to their Energy Master Limited Partnership, timber, real estate investment trusts, and TIPS holdings. Given current market conditions, now is an optimal time to add the liquid alternatives or inflation protection allocation to clients' portfolios. So how much liquid alternatives or inflation protection should you add to the client portfolios? A 5% allocation is not worthwhile given the time you have to spend explaining the strategy and the small effect it will have on portfolio metrics. Slide 8 shows BlackRock's research into the effects of a 15% alternatives allocation on risk and return over the past 15 years. To fund the allocation, they sold 10% from equities and 5% from fixed income. Even with the terrible alternative markets during the past few years, the enhanced allocation would have resulted in higher returns with less risk. Given our view that the next 5 years in the equity markets will not be profitable as the last 5 years, a 10 to 20% allocation to liquid alternatives or inflation protection should be considered by forward-looking advisors. As the chart on slide 9 indicates, capital preservation has earned over 2.25% on an annualized basis over the past 5 years. The yield is attractive while maintaining a short duration and investment grade quality on average. Capital preservation was down slightly during the quarter as the returns were negatively influenced by high yield holdings. Finally, the tactical global balance allocation outperformed its 60% 40 stocks, 40% bond benchmark in the second quarter. Since the allocation started the quarter with 86% cash and moved to 100% cash by the end of the quarter, this strategy did not significantly participate in the equity market swoon as presented in the chart on slide 10. But the small allocation held in equities, especially international stocks, led to negative returns for the quarter. As you probably know, Federal Reserve officials are publicly debating the merits of raising rates in December versus 2016. We do not believe that they're going to raise rates tomorrow. I've included some charts on slide 11 to reduce the thinking between our thoughts on this matter into 3 charts you may not have seen recently. At the top left-hand side, you will see the large rise in housing starts since 2011. At 1.2 million units, the rate of starts have doubled over the past 5 years. There has been a similar rise in auto and truck sales. The consumer has clearly become more confident about the long-term trend of the economy. On the right side is a chart of the euro in US dollar terms. The large drop in the euro has acted like a Federal Reserve tightening, since a stronger dollar results in lower prices for US consumers and businesses. In essence, the dollar has done the Federal Reserve's work for them. This has resulted in a drop in longer-term inflationary expectations, as shown in the 5-year Treasury note TIPS yield difference chart at the bottom right side of the screen. You will note that this break-even rate averages close to the 2% inflation goal of the Fed over the past 10 years. The implied over the past year, the implied future inflation rate has dropped from the 2% area down to the 1.25% area. Until expectations revert back to the 2% area from the current 1.25% difference, the Fed has no need to tighten. Our expectation is that the Fed is not going to tighten this year and may raise rates at most 25 basis points in the second half of next year. This bolsters our short-term positive view on Treasury bonds. As you carefully inspect the disclosure page, we will now begin the question and answer portion of the webinar. If you have any questions, please type them into the chat box in the lower right-hand corner of your screen. We have our first question, which is, how much should be allocated to alternatives if I want to diversify? Well, again, as we had indicated, you don't need much to have a major impact on the portfolio risk return numbers. And as the BlackRock chart indicated, even something as low as 15% can have a significant impact on the risk return allocation for the portfolio. But we suggest at least you start with 10, and then you can increase it as clients and you become comfortable with that number. The next question is, how are the endowment and liquid alternative models related? We put them on the same screen because the liquid alternative model is part of the endowment model. The liquid alternative model, if you may recall, has about 30 different names in it, and those names are in real assets, hedge strategies, and publicly traded private equity type securities. That liquid alternative portfolio is 60% of the endowment model. The endowment model is created to replicate the risk of the large college, Ivy League college type portfolios, but using liquid securities having daily liquidity. So that model has 30% global equities, 10% global fixed income, and 60% liquid alternatives. And so the endowment allocation is a one-stop where you can put your clients into a wide range of securities. The liquid alternatives is useful to, if you already have a portfolio you like, to be able to take a little from equities and fixed income and just use the liquid alternatives allocation. Are there any other questions at this time? Seeing none, I'd like to conclude by thanking everyone for attending our webinar this afternoon. If there's anything we could do to assist you with your wealth management or 401k asset allocation needs, please let us know. We can be reached directly at 869-5184. Again, thank you, and hope you all have a great rest of 2015.